Good morning. This is Mayor Valensky with Driving Markets. I hope you're well. All right, so let's just catch up where we're at very quickly. The markets yesterday, again, were very, very volatile on the back of the don't know which direction to go in. However, strong retail sales in the States came out, especially for Nordstrom, one of the biggest retailers in the US, and that pushed markets up. So there is a bit of a shopping spree going on. The US retail consumer has got appetite and plenty of money to keep on buying and spending and buying. There's a load of cash that's been produced and injected into the economy in the last 2 years, from the pandemic onwards, through to all of this liquidity and this assistance and this support. And a lot of families in the States have got a lot of money just sitting in their bank accounts, and they are spending. So there's huge demand out there, and that gave a big boost to markets. However, that spending is also showing that not only is there huge demand, but there's underlying concerns regarding inflation. So if you just take it logically, the more the consumer spends, the more that they're going to fuel inflation. And therefore, the fact that the Fed, the UK and the ECB in the near future is going to raise interest rates, I'm not sure if that's going to actually solve the absolute problem, because there's so much money floating around. It looks like that all of the inflation and all of the fear of rising prices has been taken into account, and therefore retailers are not suffering from this drop in sales. That would be a concern going forward, because the whole idea, as I said, of raising interest rates is to depress or to lower the actual consumer demand, but it's not having that effect at the moment, and rates will probably have to rise. Talking about rates, so Jerome Powell and the Fed released the minutes of their April meeting, and it shows as follows. It shows that of the May meeting, it shows that there is consensus amongst all the governors of the Fed, all the Fed presidents, that they were going to increase rates by 50 basis points in June and in July and maybe in August. Again, I don't think that is enough because of the undercurrent of demand by the consumer globally for goods and the lack of supply. When we look about lack of supply, we're talking mainly about China. China has been the engine that has driven the markets higher and driven the global economy higher from the late 1990s to where we are now. In fact, in the 2008 banking crisis, where the world potentially could have gone into a major recession, it was China who came along and saved the world by their production and by their cheap goods. So most of the world, not all the world, buy their cheap goods from China. China started the pandemic, and China started the inflation pandemic. So China is responsible for both medically and economically damaging the world. That's a fact. You can't hide that. The Chinese flu, as it was once called, is what was the starting mechanism, and subsequently the inflation is the secondary mechanism that is damaging the world's economies, and all that is due to China. Now, China has several lockdowns going on a continuous basis because they've got zero policy when it comes to corona, and that is disrupting the whole supply chain. And as long as the supply chain is disrupted and you've got high demand, then interest rates are not going to impact inflation, because the original cause of inflation was supply driven. Later on, it became money driven, so it's supply driven and liquidity driven, which is what caused inflation. Too much money floating around, which is one of the reasons why the Fed began to cut back and its stimulus program, and hopefully have that concluded by June. So we're going to have ongoing inflation, and we're going to have ongoing rise in interest rates. But again, I'm stipulating the central banks are simply not doing enough to stop inflation. So look at a couple of other things. What will get this market to move? What will get this market to rally? So there's two things that will really stop in the market's rally. It's the strength of the dollar, because the dollar is also pricing the commodities, and therefore strong dollar means higher commodities, higher prices in oil, higher prices in metals, higher prices in grains. So a strong dollar is fueling inflation, and also the US Treasury, the run to safety, the safe haven. When the money pours into bonds and pours into dollars, it's not being used to buy stocks or buy shares. And that is the main factor as regards a rally in financial markets that's being prevented by a strong dollar and a strong 10-year US Treasury. Interesting to say that in the States, home sales dropped, and even the interest rate slightly dropped on the 30-year from 5.49 to 5.46, but that did not provoke or did not induce any further encouragement for those people who are looking for homes. So home sales are down, but the prices of properties are up because there is such little property around globally that the prices of properties will remain high over the next year, maybe year and a half, unless interest rates rise significantly, where present homeowners will start feeling the impact of that rising interest rates. But a 0.25 or 0.50 interest rate rise is not going to have the impact on the housing market that we would expect to see, and it's not going to have an impact on consumer spending. So going forward, you're going to have a lot of volatility, a lot of whippiness. The trend is down, as I said specifically, and that's going to continue until there is more specific direction by the central banks, US, Europeans, ECB, and in the UK. But they are very, very nervous and very scared to take draconian action. As regards cryptos, very interesting. Bitcoin has gone into a bear flag area, so you've got to look at it whereby it's on the border of going bearish. If crypto falls below its present level of around about 20, it goes to about 28,000, that starts going to bear territory, and there'll be some algo and some auto trading that will kick it down, and it's going to go all the way down to 20,000 in the short term, and if it continues, it'll go all the way to 8,000 within 3 months. That's my view on Bitcoin. Obviously, that'll drag the rest of the cryptos down. Ethereum, or Ethereum, whichever you want to call it, ETH, that will go all the way back down to about $1,100 or $1,000 a coin. All right, that's it for now on the driving markets. You can catch me on Instagram, on Twitter, on WhatsApp. Have a good day.